Good afternoon. Welcome to Do You Know Your Risk Score webinar by Stonehearth Capital Management. Thank you all for joining us today. Before I get started, I'd like to go through a few housekeeping notes. We will have saved time at the end for some questions and answers. So if you'd like to ask a question during the broadcast, you can look at the chat box at the lower part of your webinar bar, and you can type in the chat box, and that'll go directly to my colleague Amanda Murray, who then will be asking the questions at the end of the session. As hopefully you're aware, this is our second installment of our monthly education series. I'd like to remind you that our next webinar will be March 29th at 12 p.m., where our president and owner, Jamie Upson, will be speaking about nursing home protection. It's a very interesting topic. I know I'm dealing with it with my parents, and there's a lot of good information in it, so I encourage you to join that webinar, and if you know of anybody who might benefit from it, to have them join as well. For those of you who don't know me, I'm Christopher Gauthier. I've been at Stonehearth Capital Management for about 4 years now. I'm the Chief Investment Officer, responsible for all things investment. So designing asset allocations, I chair the investment committee meeting, right down to picking the individual stocks and securities we hold in your portfolios. So with that, let's jump right in. Let's go over a little bit what we'll cover today. So the first thing we're going to cover is we're going to go through some commonly used industry definitions of measures of investment risk. These are things you've probably heard about before: standard deviation, relative performance, volatility, things like that. And once we go through, define what this risk is, how to measure it, we're going to kind of go through how we don't think they're really complete definitions of risk and that they're really missing a lot. So then we're going to go through our own personal Stonehearth Capital's definition of investment risk. And we're going to introduce you to our risk score, our portfolio crash testing score, which really helps identify what risk we're taking in the portfolio and also the reward. Because as we know, there is no reward without risk, and there is no risk without reward, or there shouldn't be anyways in most portfolios. So again, let's jump right in. We'll look at one of the commonly used definitions. What is risk? So the first one that people usually hear about is volatility of portfolio returns. This is another word for standard deviation. As you can see, I put the formula down below right there. And what does it actually mean, this formula? Well, you're just taking the sum of the difference of returns, subtracting out the averages, square rooting it, getting standard deviation. What does this mean? This means how much does your portfolio move up and down in relation to its average return. The formula looks like it's full of jargon, but it's really quite simple. And this is what most people use, and the most commonly used one, as a measure of risk in the portfolio. Now, when we hear about standard deviation, I always want you to think of the bell curve. And hopefully we're all familiar with this bell curve. It's in all kinds of stats. It's very used widely in the investment industry. But the problem with this is that, as we've seen throughout history, we've seen in actual return streams that investment returns don't fit into this bell curve. They're not normally distributed. We have these what we call fat tails, and you can see this from the chart here, where you have fat tails on the left, which are bad, think 2008, and fat tails on the right, which may be considered the environment we've been in for the past year or two in terms of U.S. equity markets. So in terms of standard deviation, one of the major drawbacks is it tries to squeeze these investment returns into this bell curve, and it doesn't work. So I don't think a good measure of risk should start off with a faulty premise, and that what we're measuring fits into this bell curve. So that's the first thing. The second thing is that it treats returns both positive and negative as equal. So what does that mean? That if the portfolio goes up 5% or down 5%, it treats it as the same in terms of a risk base. It's equally risky. I just, on the face of it, I can't agree with that premise. I mean, I think if a positive return is much better for a client than a negative return. This also, what it doesn't do, it doesn't take into account investment horizons. Every individual investor has different investment horizons. Some have a shorter term, maybe they're saving for college 4 or 5 years out when their children get to that age. Maybe they're saving for retirement, which is 10, 15, 20 years out. Maybe they're just retiring, and that time frame is 10 to 20, although with medical technology the way it is, we may start increasing that to 30 and 40 from when you retire. But the general premise is that this doesn't fit into an individual client's needs and not the individual risk profile. So the major drawbacks are, again, We do not believe that returns are normally distributed, and it doesn't take into account individual client investment horizons, and also it treats both positive and negative returns the same. What is risk for another one? Probability of negative returns. So when we think about probability of negative returns, you usually hear up periods versus down periods. The portfolio was up 80% of the time and down 20% of the time, something like that. And you also hear in terms of the percent of positive observations in terms of months, quarters, years. So the past 5 years we had 3 positive returns, 2 negatives. In the past 5 years, 80% of the months have been positive. While this is helpful to find out in terms of how a return stream is distributed, it fails to take into account the magnitude of the loss. And there's a big difference between multiple small negative returns and infrequent but large losses. So when you look at it and you think, okay, if a portfolio loses, a basis point here, basis point here, basis point here, basis point here, then has a 5% return, it may only have one positive month of returns, but that positive month made up for all those small negative returns. Vice versa. If I have multiple small positive returns and then get hit with a 30 or 40% loss, like we'll see in the next chart, it's hard to recover from that. So hopefully most of the people are familiar with this. We use this a lot in our work. It's done by Crestmont Research, great research outfit. And this is the impact of losses. And this really focuses in on why the number of losses and number of gains doesn't really matter, but the magnitude really is what drives your overall ability to achieve your goals. And again, it's very simple. If you look at the chart over on the left, over here, you have 10% loss. So if your portfolio loses 10%, you never like to lose money, but if potentially it does lose 10%, you only need 11% gain to get back to pretty much even. Move out the scale, if that loss is increased to a 50% loss, you need over 100%. And I won't even talk about 60, 70, 80, and 90 because I don't want to scare too many people, even though we're talking about risk here. So again, this really shows that when advisors or other people in the investment industry start talking about the number of positive occurrences they have in their portfolio, it really doesn't identify the risk in the portfolio. Risk should really be viewed as not only the number of occurrences, but also the magnitude. So those are two of the most commonly used ones, and we'll go through one more here. And this is my least favorite of all the risk measures we see out there. It actually drives me crazy. And you'll see it quoted as relative performance to a benchmark. So what does this mean? You usually hear a phrase like, your portfolio outperformed the S&P 500, the Lehman aggregate. It outperformed the NASDAQ. It outperformed a 60-40 portfolio. That really means nothing to you achieving your financial goals. It doesn't distinguish between positive and negative like we've seen. And I always go back to old phrases in this industry because they're old for a reason. They're around because they actually have truth to them. And I've always been told when I first started in this industry that you can't eat relative returns. And that's an easy way, quick way of saying, you know what, it doesn't matter if I beat a benchmark or not. If I lose money, I still lost money. And this next chart will kind of go through it. So look here, relative performance. So all this is showing is a simple made-up portfolio. Say it gains 1 year period, it gains 10% relative to the S&P 500. So as an advisor, I'd go to, look at this portfolio. It's a beautiful portfolio. We outperformed the benchmark by 10%. At first glance, at first blush, you would say, that's pretty good. We're very happy with this. Unfortunately, if you go back to 2008, as an example, that same portfolio, the same numbers, you look right here, consider this the S&P 500 lost 37%, you still lost 27%. So yes, you had a positive relative return, you beat the benchmark by 10%, yay the advisor, but your portfolio actually lost 20% of its value, which is not good for the investor. So really focusing just on relative returns doesn't really help the investor understand what risks are in their portfolio or what risks they're taking and what risks they should be taking. So again, this is helpful in terms of describing some characteristics of portfolios, but in terms of defining what risk is, it really does not sit well with me. So that's kind of the 3 most commonly ones we used. Again, risk is a multifaceted and very deep topic, and I'm sure everybody's heard one of the pet peeves from other advisors, but these are the 3 I hear most common. And they do all share some common detractors. So whether some of the drawbacks, backward looking. Most of this is focusing on what has happened in the past. My portfolio has done this in the past. This portfolio has done this. It doesn't really tell you what's going on in the future or what potentially could happen in the future. And if you think about it logically, that's what really matters. It doesn't really matter what your portfolio, what an advisor has done in the past. It really matters what's going to happen in the future. And that's what we really want to focus on here. The second one that's common to most of the risk definitions we see is that they tend to treat gains and losses equally. And we've been through this. We saw the chart where, all returns are not the same. You can't treat all losses the same. Magnitude really does matter in terms of meeting your financial goals. And the one thing they all have in common, the biggest one I think, is that they're more relevant to the investment manager or the advisor than you. And all about risk in your portfolio should really be focused in on the end user, which is the investor, which is really you. So while we use these in some of our analysis, and you hear us talking about these aren't all the all-encompassing risk measures that we like to use. And we saw that the world was really lacking in that all-encompassing risk measure. So we set out to kind of define how we view risk as a company and how investors should be viewing risk. And what we've come up with is a very simple phrase. It's very easy and neat. It's the probability of you, the investor, the client, not achieving your financial goals. It's very simple to say, but very hard to do, and it just really drives me crazy that more advisors and investment managers don't look at it from this perspective. They're always looking at it from their perspective. How can they do? What are they doing? How's their portfolio doing relative to a benchmark? Rather than saying, are we meeting the goals of our clients, and can they achieve their financial goals? So given this definition of risk, the next step in the process was, now that we've defined it, how are we going to measure this? How are we going to communicate this to our clients? How can we have a very intelligent conversation with a client about how much risk they're taking in their portfolio if we've already identified that most of the risk measures that most people use out there really don't meet our needs? And we're lucky enough to find a company. They're called Rick Streamer. They're an independent third-party company. They grew up on the institutional side, and all that means is they advise a lot of big corporations like CalPERS, GE, things like that. And they started their own company to really bring that high quality measure of risk that really to the end user, to the advisor level. I think the thing that we like about them the most is, other than their focus totally on the client, is they use history as a guide, but their numbers are really forward-looking. So they really focus on what potentially could happen. They also use real-world performance measures. So they use what we call crisis correlations. What does that mean? Correlation, hopefully we're all familiar with, is just how things move in tandem together. If you have a correlation of 1, you move lockstep and barrel with that. We know through history that investment returns all correlations go to 1 during crises. We've seen this in the past. History has shown this happens, yet most of those other definitions of risk use that normal bell curve and try to fit it into a normal distribution and don't take into account that things change during crises and that correlations go closer to 1, so we use crisis correlations. Why do we focus so much on the crisis aspect or the drawdowns in portfolios? It's because that's what matters. And research has shown that most investors focus more on loss aversion than they do on winning. And what we've seen throughout history from investors, from what in real world, is that most mistakes are made during losses. It's that loss aversion phase. And the big reason that happens is they didn't know the amount of risk they were taking in their portfolio and they couldn't measure it and understand what they were taking. So again, this focus on loss aversion, these crisis correlations, is what really happens when you're trying to achieve your goals and when we can do the most harm to achieving those goals. So what I'm going to do right now is show you a little bit example of the portfolio crash test score system. So I'm going to pull this up there. Hopefully this pops up. And you should be seeing it on your screen now, portfolio crash test with the little piggy bank. If anybody's not, please enter it in the chat box and Amanda will get you set up. So what we're looking at here is their software. It's a very simple portfolio. It's on the left-hand side, you can see it's the S&P 500 index, and it has what we call a crash rating of 71. What does that mean? It doesn't really mean anything to anybody. So what if I'm a 71? What if I'm a 50? What if I'm a 40? What they do, Rick Streamer, is they model out returns from a 0 to 100 ranking. So we standardize and normalize our returns. So every portfolio gets a score between a 0 and 100. What it's doing, it's taking these scenarios down here, taking the 3 worst scenarios, which we see right here, and we'll go into the details of these scenarios, to calculate this score. So as a ranking of 71, what it means is that in a stock and credit collapse like we saw in 2008, this portfolio could potentially, again, we use the past as a guide, it doesn't guarantee the future, but it's always a good place to start, is that this portfolio could potentially lose right around 40%. And if we look back to 2008, the S&P lost, I believe, 37.8% during 2008. So it's very accurate there. It's easy to do that when you're looking back. But again, if something like that would potentially happen again, we could see this portfolio lose 40%. If you look up at other definitions like commodity crash, this portfolio could lose 20%. So again, this score of 71 directly relates to actual events that have happened and models out what could potentially happen in the future. So again, it kind of checks all the boxes. One, it's forward-looking. It's looking at what potentially could happen, not what has happened. It does use the history as a guide. That's what we have to start with, but it really focuses on what potentially could happen. Second, it's really looking at from the investor's use, like what could happen to my portfolio in these crises and what would happen to my mindset, my loss aversion, if I was potentially to lose 26%. So the way they kind of use this is, all right, this is good. It tells me that I could lose 40%, but I could also, if stocks are up 30%, gain 30%, and which makes sense because it's a 100% stock portfolio. But again, it's that risk-reward trade-off. Really looks at the difference between if I take X amount of risk, I get X amount of reward, and what's that trade-off? And the good way to look at this trade-off is if we compare it to another portfolio. So what I'm going to do is pull up a simple 60-40 split. So what is a 60-40 split? 60-40 split is 60% in the S&P 500, 40% in a bond index. And what would you expect is what we see. We lower the risk. So again, crash rating score 71 for just the S&P. We go over here to 47. So we saw we reduced the risk a lot by just adding 40% bonds, which makes sense. So we look at that stock and credit collapse of 2008 again. That 40% return turns into a potentially 10% loss just by adding 40% bonds. So most normal people, like myself and everybody's on the thing, would say, of course I would take that. I would rather only lose 10% in those crises than 40%. That looks good to me. But there is a trade-off. When we go on to the positive side of the ledger, and that first S&P portfolio we look at, and it would have gained 30% of stocks are up 30%, we go over to the new portfolio, we're only gaining 16%. So again, really focusing on that risk-reward trade-off. There is a trade-off. We can reduce risk in anybody's portfolio to whatever they really potentially could want and reduce returns, but you don't get the positive return. So there's always a trade-off between the two. And this is the software we like that really shows that and can start stimulating conversations between us and the client about how much risk are they really taking in their portfolio, how much do they want, and also how much they need to achieve their goals. Because again, if we go back to how we're defining risk, the risk is a probability of you not achieving your goals. So we can take that into account when we look at these portfolios and say, okay, what would happen if your portfolio potentially lost 40% in a stock and credit collapse? All right, I can't take that. It would hurt the ability for me to achieve my financial goals, so let's lower the risk. Well, that's going to lower my potential positive return. Can I still meet my goals by reducing the risk? If you can, then that's a good portfolio for you to have. So again, this is how we compare portfolios, and the one thing we like about this, you could add multiple portfolios. I'm not going to do it here because it gets really convoluted on the screen, but we can bring in any portfolios you want. You can bring in your real-time portfolios, which is another feature of the software. Is this is directly linked to your accounts if you're a client of Stonehearth Capital Management. That feeds in directly from our custodian. So it's not what we hold, it's not our records, it's directly from the custodian, feeds in every day, gets updated in real time, so you can actually see what your real portfolio, not what a model says would potentially happen to your portfolio, your actual holdings. And you can view that against other benchmarks, other indices, other portfolios. We can add outside holdings to really get your overall financial level and what you are very comfortable with holding in terms of risk reward. So I'm going to go back to a single portfolio here. We're back to just the S&P 500 index. I'm going to pull up a more diversified portfolio because I do want to show you another feature that is really helpful in trying to understand how much risk you're taking in a portfolio and how can we adjust that risk to suit the client's needs. So I'm just pulling up a moderate portfolio. This isn't anybody's holdings. This isn't a portfolio. This is just a hypothetical moderate model portfolio. First, you can see it's a crash test rating score of 56, much less than the S&P. Stocks are up 30%. It's up 19%. Better than the 60-40 portfolio, which is just kind of modeled after, but still the return on the upside is less than the S&P. But again, I'm all right forsaking that bit of upside because I get this much more protection on the downside. I save myself 10% on the downside by having this portfolio. So one way we use this software is that we're talking to the client, we're looking at this, we're understanding risks and rewards in the portfolio, what's the trade-off, and we said, you know what, this really feels risky to me. I don't like how this is distributed. I'm not sure I really would like this type of portfolio. I really want to control for risk. What we can do is, in a very simple way, just move it down. Now again, we would put constraints and put different things in here about what we would buy, but it gets the picture across is that the software went in and adjusted the crash rating down to 48. So that's the blue line. So these are your new potential outcomes given the new portfolio, and you can see the trades right over here on the left. So in that 2008 credit collapse, you went from losing 28.8% potentially to only losing 22.5%. Sounds good. Well, what did we give up? Well, we gave up some upside. So in terms of the stocks going up 30%, our portfolio would have went up 19. Now it's only up 14.5%. So again, it's really getting to the focus of what's that risk-return trade-off between that. And it works in the opposite way too. If we want to move up, it moves the same way. We want to increase the risk. Also, it helps us deal with the future in terms of what is most likely to happen. So you can see one, Ukraine hostilities. Not sure that's a really high probability of Ukraine hostilities happening. Again, it's not negligible, it's not zero, but you know, we're not really sure that's a high probability event. Emerging markets hard landing, we don't think that's a high probability event. Commodity crash, maybe. Oil has had a nice run. This is kind of a higher probability. We really want to protect against commodity crash. What can we do to this portfolio to help us do that? Well, we know that we would potentially lose 14%, and let's focus that to say maybe let's only lose 10%. Well, here it goes. Boom, tells us right again on the left what trades we need to bring that down. Again, these are all potential. These are forecasts. There's no guarantee here, but we're increasing the probability of protecting ourselves on the downside for this risk. So we've got a commodity crash loss down to a minimum 10%. But again, look at the upside. We lost some upside. So instead of earning 19%, again, that stock's up 30%, we're only earning potentially 13.5%. So again, you can see how you can keep reiterating, going through and having an intelligent conversation with the client to talk about what is a proper risk level and what is a proper trade-off between risk and return in individual client portfolios. The other neat thing too is, again, when we started this, is that it really should be focused on the investor and not so much the advisor. So really how this impacts you. And go view this really quickly is retire risk feature. In conjunction with your portfolio, what it's taking over here is what would potentially happen, and we can adjust those assumptions. So again, in investment horizon, it's very unique to individual clients. We can adjust that. Is your horizon 38 years? We can adjust that. Is it down to 22? Or maybe it's only the next 9 years you want to do it. You can do save more. Do you want to add more money to your portfolio? And you can see this bar changing here. And what it's doing is it's taking your initial portfolio, your actual dollar amount, 100%, and forecasting out what would happen given these current assumptions. If your horizon was 9 years and this was to happen in this portfolio, you would end up with this. And you were saving more in years, and you can do withdrawals. The thing too is you can add crashes, and this is what really focuses on. You can do the timing of the year crashes. So what happens if a crash happens right away? What happens if it happens in year 2? And you can save, and you can see the portfolio adjust. So this is what would happen if we had an immediate crash in your portfolio. It would draw down, but then you'd start recovering in year 3, year 4, year 5. So how do you view this? When we look at this, it's very, excuse me, it's very unique to each individual client. Some clients, giving long investment horizons, may be able to handle that initial drop down. They're not withdrawing from the portfolio, they're contributing, and that's an all right portfolio to have. Where we can get the same typical investor, same amount of money, but has a different mindset, and maybe they're retiring in 3 years, and they really need to start drawing down their portfolio, and they really can't handle this big drawdown in the portfolio, so we can adjust it. We can reduce risk, control that downside. So again, the big thing to take away is that it's really focusing on what the investor needs, what you need, and how can we get you best to increase the probability of you achieving your financial goals. So we're going to go back to this, the single, the moderate. The other one more feature I'd like to talk about before I kind of wrap up here and answer your questions is looking at these individual scenarios. You can see what would actually happen with portfolio holdings. So if the Ukraine hostilities, and they were prolonged, and there's definitions of what happened here we go through with, what would happen? Well, this part, double line total return you're holding, would help performance while you lose money in emerging markets. Makes sense. Ukraine and the countries around Ukraine are mostly classified as emerging markets, so you by definition, they would lose a little bit more than you think with a bond fund. So you can actually go into and view the individual holdings to see how they would potentially affect. And again, I don't want to hop on it too much, but again, these are projections. They're not actualities. You can't sit there and say, if Ukraine's hostilities prolonged, this portfolio is definitely going to lose 16.9, but it gives you an idea of what potentially could happen and what the range of outcomes could potentially be in your portfolio. So again, I know risk is a multifaceted and very difficult topic to talk about. We've only scratched the surface here. This is definitely as deep as the ocean and as wide as the continents. It's just that we're trying to get you a little taste of how we view risk and how you should be viewing risk when you look at your investment portfolio. So before I wrap up here, we're going to go back to the thing and we're going to do some conclusions. So what are our conclusions? Well, the first one going through this is that traditional risk measures like we've seen before, standard deviation, relative returns, percentage up or down into the portfolio, they are helpful. We do use them in our practice, but they're not complete. They're really missing something, and they should not be used in isolation or in terms of defining risk. Second, risk is multidimensional and should be viewed from a risk-reward trade-off. Now, people, when they look at risk, tend to only focus on the negative, but we also have to focus on there is a reward with the risk you're taking. And by increasing risk is not necessarily a bad thing all the time if you're getting an equivalent amount or even greater amount of reward on that side. Same thing reducing risk. It's all right to reduce risk, but as long as you understand that, you're going to reduce that potential reward and understand that trade-off you're taking. And it should be viewed in multiple time frames, depending on the individual client's investment horizon. And lastly, the biggest thing to me, drawback that all these measures have is that they're always viewed from the manager's perspective and not the investor's perspective. And the biggest way I can kind of display this is I remember working for an old company on the buy side back in 2008 collapse. S&P was down 40%. We ran a U.S. equity portfolio that was down 22%. And there was literally upper management giving everybody high fives because we beat the benchmark. And I'm sitting in my office saying, we beat a benchmark, it's great relative returns, but we actually lost our clients 22% in our portfolio. And that just never sat well with me. So again, starting from there on this journey is really we came to this conclusion about how do we define risk? How should we be defining risk and how we should be measuring in your portfolios? And we feel with the invention of Risk Streamer, the ability to judge the risk-reward trade-offs, to identify what risk we're taking, where we're taking, and change investment horizons, we are really able to meet what is important to the clients. And what's important to our clients and our investors is the probability of you achieving your financial goals. So again, that's the basic presentation that we've had today. I would love to hear any questions you may have, any thoughts, anything like that. So I'm going to turn it over to Amanda, who's been monitoring us, and see if there's any questions out there. Amanda?
Hi, Chris. I do have a couple of questions. The first one is, what is a good risk score?
Sure. That's an interesting question because I always get that when I show this. It's like, okay, so my portfolio is a 56, the S&P is a 71. What should I be? It really is unique to each individual investor, which is why we don't send out reports to these and we don't publicize these numbers on our website or anything like that. Because again, we look back at the definition of risk, of how we define it. It's the probability of an investor or you not meeting your goals. And those and the probability of you not meeting your goals is very dependent on your own individual financial situation. So what we do is we do basically interactive with the client, is sit there with the software in front of us and have a conversation so we understand your goals, your needs, your risk tolerance level, what your financial strength is. So it's really unique in an individual. So a crash test rating score of 70 compared to 50 is not better or worse. What it is really trying to get at is what is the right crash test score for you, the investor, so you can increase the probability of achieving your financial goals.
Just expanding on that, Chris, does the risk score change over time?
It's interesting. Now we know risk is not static. It does change over time. So risks increase in the market. That's one of the big things we believe in here, that the level of risk in the market fluctuates over time. It's not static. That risk score will not change over time. In terms of a 2008 crisis, the probability and the outcomes are always going to be around that 40% for that type of portfolio. So it's always going to be at that risk score. What we tend to do is, in terms of how we look at client portfolios, is that a client, after the market, in the current market situation, maybe they're good at a risk level 56. The market goes up 20 or 30% from here. They still have a 56 crash test score, but given the market environment, given what we see in technicals, what we see in fundamentals, what we see in the macroeconomic environment, that their risk score has changed from a 56 down to a 50 because of that increase in risk in the market. So we would adjust that risk score. So the risk score doesn't change. That portfolio is always going to be a 56, but we'll adjust the individual holdings to lower that risk score to a more appropriate level to meet an individual client's needs.
Another question we have, Chris, given what you presented on standard deviation relative to a benchmark, why do you still use them, and why do you include benchmarks on your report?
Good question. So I just spent a good part of a half hour saying how bad all these definitions of risk that people are using, and then we present a benchmark, and we talk about standard deviation too. And to me, the big takeaway is that they are useful, but they're useful in their own context. They're useful to help explain characteristics of a portfolio. What they can expect that may happen to their portfolio. But that really has no bearing on them achieving their goals. So it's good to explain stuff, to judge stuff, to explain what's going on in the marketplace. But in terms of defining risk and measuring how much risk you're taking, they do not work. They're not complete. You really need to look at it from the overall portfolio level in terms of risk-reward trade-off, and really that ability of you meeting your financial goals, which you believe the crash test score is that all-encompassing risk measure.
The last question I have, Chris, is do we send out crash test reports to clients, or how can a client get their crash test report?
Sure. Again, as I stated before, we really don't send these out to clients too much until they've had real experience with the software. And there's a reason behind it. You can see how much information there in the interaction. And this really works best when the advisor or myself is sitting with the client going through all the multifaceted facets of risk that they have in their portfolio, their risk tolerance, how much their financial strength. So this really is a communication and a conversation to have with the client sitting there so they can understand what's being taken away, what's being added, and really get a full understanding of the amount of risk they're taking. So I think a lot of advisors just send out reports without explaining what they're doing, and it leaves the investor at a disadvantage. So we really believe that having that conversation, and we do it on webinars like this, on private one-on-one webinars, we do it in the office, and it's very easy to set it up. So if anybody would like to discuss the report, like their own crash test rating score or anything like that, you can always call the office, set up an appointment with Jamie, David, or myself, and we can walk through your individual unique scenario and figure out what is your portfolio crash test score.
That's all I have for questions, Chris.
All right. Well, again, I'd like to thank everybody for joining us today. Doing this, there's also, just to let you know, there is an accompanying white paper that is on our website now, or you could email Amanda if you would like a hard copy of it. We invite you to read that too. We also invite you to share with your friends and family members about, I think, to us, the biggest thing is to educate investors out there to really understand what risks are in their portfolio. And I think the biggest thing missing from most advisors is that they don't do that. So we'd love to sit down, talk to you or your friends and family about this crash test score, what it means for you achieving your financial goals, and how this could potentially impact your investment portfolio going forward. So again, I'd like to thank you all, and again, if you'd like, call the office 978-624-3000 to set up an appointment, or you can go to our website www.stonehearthcapital.com for all the information. Again, thank you. Enjoy the weather. It looks pretty nice out there. It's a little cold, but not too bad for a February month. So thank you all and enjoy.